Welcome to the MUFG Global Markets Podcast. I'm John Cook, and today I am joined by George Goncalves, MUFG's head of U.S. macro strategy, and Agron Nicaj, MUFG's U.S. desk economist, for a special podcast preview of what to expect from the Fed's Jackson Hole Symposium. It's Wednesday, August 26, 2026. Welcome back to the podcast, George, and welcome back to the podcast, Agron.
Yeah, no, John, it's been way too long. Definitely looking forward to catching up, and it's great to have Agron on as well.
Yeah, thanks, guys. It's great to be on.
Yeah, we'll echo both of those sentiments, George. Hopefully, we can get back to a regular cadence here. So George and Agron, given you guys as a team have and the team rather have covered a lot of ground in the macro strategy Jackson Hole preview entitled "A Pit Stop on the Path to No Hikes." Why don't we start by breaking down the piece for our listeners after we hear from Chair Warsh on Friday and the macro thinking around that and the market implications.
Yeah, sounds good, John. Let's go.
Okay, let's start with the big picture, George. As was outlined in the piece, you see three potential scenarios that Warsh can take when delivering his opening remarks. Clearly laid out in the piece, but again, let's go over them for our listeners. And incidentally, this will be Warsh's first keynote speech at the Jackson Hole Symposium. But what are you looking for on Friday, and what are the risks that you see around those three scenarios that you've laid out? Perhaps let's say that he doesn't do one of those scenarios or he veers a little bit. Talk that through for our listeners.
Specific to the event that lies ahead of us, we see three potential kind of option scenarios of many options. And we just wanted to kind of distill them into three possible sort of outcomes. One, which has been what we've been kind of seeing a lot the last couple times that Chair Warsh has spoken. He's kind of kept his views close to the vest around what is his reaction function. And even at the press conference in July, he did mention that he's not clear what sort of speech he was going to give, either some sort of medium-term outlook or what to look for in the next couple of quarters. And by now, I'm sure the speech has been written and prepared. So we're going to find out, did he take the option of a more longer-term shelf life piece? The symposium is geared around digital payments and the evolution thereof and the interaction with monetary policy. He can strictly just kind of stay focused on the digital side of the conversation. And that would be a disappointment for the markets. That's option one. We don't think he's going to do that, but it's clearly always a possibility, given that he's been kind of hesitant on giving forward guidance. Or he could take what we kind of suggest is more of a balanced, neutral approach, speak about the topics that are germane to the conference, like digital, but then transition towards the end and say let's turn our attention to kind of current events and and macro conditions and rates. I think that's more likely what he'll do, and just kind of give some sort of latest thinking and context of what's happening, and how to think about recent developments in the economy. That's our kind of option two. And then option three is what the wish list, what the markets want, which is he kind of flips the script and goes and really explains how things are evolving around the task forces, really provides updates, metrics that they're starting to capture, how things are evolving, and how that's going to help modernize the Fed. And that would be what the markets want. We don't think that's going to happen, but it's obviously a possibility. So those are the three kind of big potential options that Warsh may choose to kind of deliver the message on Friday.
So just to get a little bit more specific there. So I get that he doesn't want to give us forward guidance, and I'm kind of okay with that. Forward guidance was introduced when rates were really low and they needed to sort of make financial conditions more accommodative by kind of talking down the rest of the curve. But isn't it reasonable to expect him to kind of really go through the thought process, which again sounds a little bit more like your option three, but you're not necessarily expecting that. So why would he be reluctant to talk about not the outcome, but the process?
I think because he's very much a data-centric individual and process-oriented, and the fact that the task forces are in place, maybe he doesn't want to presume what the end goal will look like and the outcome thereof, and so he doesn't want to.
So he doesn't want to like front run the conclusion of the task force. Said another way.
Yeah, something to that effect, and of course, like he's the chair of the Fed FOMC, and also I think would not want to kind of like set that agenda at this stage, considering that there's a meeting only a couple of weeks away. So I think he would probably want to not kind of tee up anything or dispel either yay or nay on what will happen next. So I think he would probably want to just keep it very high level, give some updates, maybe introduce some elements of what the task force is coming back with. There is there's been in the minutes a focus around the balance sheet, and that's something that he's been really focused on over the years. He's mentioned potentially looking at different measures of inflation, like trim mean and median PCE. He could even go into the idea around the Fed has really three mandates on like long-term rates also being stable. Like he could do all those things. We just don't think that he would want to broach those topics at this point.
Okay. Maybe we can talk about market implications for some of those scenarios a little bit later. But for now, let's pivot to Agron. So also in the piece, there's a macro section. I think, to briefly summarize, I think our view is that the data has softened at the margin. And so there's not a compelling case to make that the Fed should hike at the upcoming meeting in September. I don't know if I know a lot of people who disagree with that, although I think I know some market participants who are fearful that the Fed might do that. Talk us through that.
Yeah, that's exactly right, John. Basically, since the last FOMC meeting, the data has largely not been in support of hikes or just in general more aggressive monetary policy. When it comes to the consumer, we saw a pronounced pullback on spending in July. We saw that in the retail sales report. We saw that in the more comprehensive PCE data. Now, granted, some of that weakness can be attributed to some of the seasonality issues related to Prime Day, but even if we kind of smooth that out, the general trend is still the same. As more and more of the tax refunds get spent, we can expect a continued slowdown in consumption. On the labor front, it is a bit of a mixed picture. We keep hearing the term balanced being used to describe it, and that is an appropriate term given how low the unemployment rate is. But I would describe it as more of a fragile balance. The 3-month moving average for non-farm payrolls has fallen to just 20,000, and this is down from around 140,000 back around May. And it really hasn't nudged up even a bit if you look at the job finding rate. So overall, even though we do have this supply and demand balance, which is keeping the unemployment rate relatively low, we don't necessarily see this as this robust expanding labor market that some of the more hawkish members on the FOMC were pointing to earlier in this year. So yes, the labor market is not flashing red, but we don't think it's stable enough to withstand another hiking cycle. On the inflation front, things are generally moving in the right direction. We had a very soft June and a relatively soft July core CPI print. PCE was not quite as soft, partially driven by financial services. But the BEA is going to implement some methodology changes with the release of the August data. And that's going to fix a lot of this overestimation in things like portfolio management services. So if we zoom out a little bit, wages and unit labor costs are not indicating that we have an embedded inflation problem, at least not with respect to aggregate demand. On the supply side, energy costs are going to be less of a thrust on overall PCE and CPI. Sure, we do have some kind of supply side issues, but those are expected to fade in the coming months and quarters. So we do have another NFP and CPI print until the September meeting, but it's really likely not going to be enough to persuade the doves or even move the more neutral voters into a more hawkish stance. We might get a little bit stronger of a spending report, a little bit, somewhat stronger of an NFP, but it's really not going to move the trend away from what we saw over the summer months. At least we don't think to a significant degree.
Yeah, and I'll also add, John, like it's the window is kind of compressed. We're coming into, well, NFP will then right afterwards start the blackout period. Then we have Labor Day weekend, which is starting later in the month, and then you get the CPI that same week. Then the Fed the following week. We're not going to really get to hear much because we're going to go into blackout, so we're not going to get a reaction. If the data is slightly better or outperforms expectations, like as Agron said, we don't think it's going to be strong enough to really sway them into a hiking cycle. So it's going to really hinge on what Kevin Warsh says at Jackson Hole. So Fed speakers have been cutting back on speeches anyhow, which we covered in the piece. And this really comes down to does Kevin Warsh want to tee it up? We don't think he does. And if the data even is slightly better, I don't think it'll be enough to sway the Fed to hike.
Yeah, I mean that seems reasonable. Agron, kind of back to you. I do tend to, we talk a lot, and I tend to agree with your view. But let me play devil's advocate. So inflation has been above the Fed's target for as long as I can remember. I think it's 5. I think Warsh himself has said that. Warsh himself has said that inflation is a choice. The unemployment rate at from 4.5% to down to 4.1% is tight by any measure. I think there are many measures of nominal R star that suggests that the current policy rate is not particularly restrictive. I think. I guess my question is what are the risks that the Fed could be looking at, and all these, and I guess tell me why these things don't warrant a hike. Maybe it's not September, but later down the road.
Yeah, sure, John. There are certainly risks, things that can push the Fed in one direction or another. I'm going to start with the revisions to the non-farm payrolls, at least the preliminary revisions. Those are going to be released on the same day as Jackson Hole, and I think it's not necessarily a risk factor, but the data is suggesting that it's probably not going to be as large of a negative revision as it was in the last 2 years. The data, non-farm payrolls and QCW employment growth has largely been in line with each other from the April 2025 up until Q4 of 2025. So far, that's the data we have available. So that's certainly not going to be, I guess, a headwind in that sense that will keep rates on hold. But we do see kind of a little bit of resurgence in the manufacturing sector, specifically with advanced manufacturing. This is related to the AI build out. This is also related to the defense sector. But in general, more advanced manufacturing is seeing a bit of a kind of a renewed resurgence in the United States. But overall, I would say if I were to pick one thing that would really push kind of our risk factor away, it's elevated inflation. You made the point that inflation has been for 5 years or so above target, and we do seem to have these persistent supply shocks. Now, if these don't fade as quickly as we expect them to, or if we just continue to experience new supply shocks in one way or another, this can keep price growth elevated longer than we would otherwise think. And this is something that can also kind of push the FOMC potentially in one way and make them a little bit more hawkish than they otherwise would be. However, with what we are seeing, we don't really think that these supply shocks are going to be sustained for the duration of the next 2 years. We think in general, most of the effects have peaked. This is with respect to tariffs. This is with respect to energy. So we should see things coming down at least through the duration of this year. And then heading into next year, we think it's going to be much less of a factor.
Yeah, that's I guess said another way, the base effects for inflation are positive. Assuming we don't, these persistent trade wars that cause supply shocks or actual wars, don't keep popping up. I can buy that. All right, so let's pivot here. And wrap things up with, I think with the, one of the most interesting things is like, let's say Warsh doesn't tee up September, let's say the Fed does not hike in September. What does that mean for our medium term view for the Fed, for the rates, for rates rather, and for, financial markets more generally? I also would be curious if we can touch on it. I would be curious what we're kind of expecting from market reaction from those options 1, 2, and 3. So I know there's a lot there, but how about George? I'll give you first bite at that apple.
Yeah, let's maybe take the last part first. I mean, in terms of market reactions, we've rates markets and markets in general are not just reacting to just one specific catalyst or stimuli. We also, we've had recent news around the Treasury buybacks, which also has had an impact on the rates markets. We have earnings that are being released. We have a lot of different things that are influencing market dynamics. But we've also been in a steady rise in rates over the course of the summer, which have at least for now kind of paused and gone the other way, and given some relief to the bond market. Given the sort of backdrop that we're in, speaking of the event itself, which most people are going to be most interested about what we think about Jackson Hole after listening to this podcast, and then our medium-term views I'll get to in a second. We think that given that we've kind of retraced in rates a little bit, if we get our base case view of a more balanced speech and without giving all the details of Kevin Warsh's reaction function, that it could be plus or minus 5 basis points, depending on where we kind of go into the meeting and how forceful the language is. So it should be a relatively non-event because we've retraced a lot of the sort of pressure that the bond market's been under, and we have rallied a little bit. So if it doesn't sound as forthcoming, then maybe you get some sort of kind of retracement, but it will be limited because we have month end the following Monday, and we still think that rates are still relatively cheap. So they're at the higher end of the range. So I still think that any sort of kind of sell off will be bought. And then that's for our base case. In the worst case scenario, he doesn't really go into anything, and he just speaks around the idea of money market plumbing and digital finance, and doesn't really go into the macro. I think you get a decent bear steepening. I think that in general the curve might just parallel shift higher with a bias towards long-term rates, because that's where most of the pain has been. So I think we'll get higher rates across the curve with the back end really suffering the most, because he's not really offering any sort of insights into how he's thinking. And the best case scenario,
plus the market wants to potentially test the Treasury's appetite to buy.
Yeah, exactly. That's all connected for sure. And then the best case scenario is that we get like some updates on the task force, the metrics that they're looking at, and a kind of really coherent kind of game plan of what the next 3 to 6 months look like as we get more information from the task force. How's that going to potentially help guide the FOMC and help in their thinking about implementing policy? And anything on the balance sheet that suggests that maybe the balance sheet is not that large, and that the balance sheet, adjusted for the economy, is kind of grown into the economy. If he says anything along those lines, the market's going to rally pretty hard, right? So I think if he tempers the balance sheet kind of concerns, talks about the task force are in motion, that'll be like the best case scenario. That's like the immediate reaction. And then our medium-term view, kind of like teeing off the stuff you heard from Agron, that what would make us change our view. For those that know our view, we've been much more on the dovish side, thinking that neutral is actually either for now short-term neutral is probably within reason, but we think the long-term neutral is still lower. There's still a lot of debt in the system, and the consumer is kind of feeling most of this, and the job growth is not there. So among other reasons why we think that rates should be slightly lower, but we push forward our kind of rate expectations into 2027 in terms of easing, and for us to change our view to not see them cut and or hike, you would need to see, like as Agron described, an increase in inflation expectations, actual inflation rising, and a jobs market that turns around, maybe on the back of some of this manufacturing renaissance that's happening in the U.S. Like if that were to happen, then we can maybe see a scenario where the Fed hikes. But if they're hiking, they're not going to just hike once. They're going to hike at least 2 times. I mean, if this idea of this one and done idea, we don't subscribe to that. So if they're going to either adjust policy in either direction, they're going to either do it at least two times. Either going to hike 50 or they're going to cut 50, depending on the conditions. And that's what makes it kind of challenging. And I think because of that uncertainty, we think they're not going to hike in September. But all that's going to happen is the market's going to push forward those rate hike expectations to December. So unless the economy becomes weaker in December, the market's going to still price in the chance of a hike at the end of the year. But they're going to keep doing that iterative process until either the economy gets weaker, or if it gets stronger, then they're going to price in more hikes, right? So I think that sort of bias. Yep. And I guess last point too, like I think, there's an idea that, that the Fed has to kind of hike in parallel with other central banks. We don't think that's the case. I mean, so like it is quite possible. Our house view is that the ECB will likely hike, and there's a chance that the Bank of Japan might also hike in September, but we don't think that the Fed has to go along with it, and that they'll probably hike. If they do hike, it would be later in the year if the conditions are there for it. But for now, we think that between the midterms and between the given the trajectory of the economy, and that's not strong enough in our view to kind of sustain a hiking cycle at this point, we think it would be later, not sooner.
All right. Great stuff, gents. So I guess why don't we close it there? Thank you. For our listeners, I would encourage you to check out George and team's 2026 Jackson Hole preview, again entitled "A Pit Stop on the Path to No Hikes." And if you are still not receiving their good stuff, get in touch with your friendly MUFG salesperson, or check out the MUFG research portal at www.mufgresearch.com, where you can find all of your favorite MUFG research, as well as sign up to have it conveniently delivered directly into your inbox. As I said, great stuff as always. Thank you, George. Thank you, Agron.
Thank you.
Thanks, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.